Hi, this is Osama Rizvi and welcome to another Monday Macro Review. Today's Monday Macro Review is a plus edition. I would be speaking to you, interacting with you for a little longer than usual because there are lots of interesting items that needs to be discussed. So first of all, we'll discuss, of course, the global economy, something about the global oil markets, and finally, today's what happened yesterday with the OPEC decision. So first of all, very important is the credit flow. Credit flow simply is the amount of credit, and one of the measurements for this is the credit impulse. What is credit impulse? Very simply, it's the change in new credit issued as a percentage of GDP growth. And this credit flow, this credit impulse has been falling in the major three economies. Now that's a really important factor, a macro factor. Look at this thing. So credit impulse turns out to be a leading indicator. You can see that it follows where it goes. The US real GDP rate also follows. This is recently, and you can see that as the credit impulse takes a dip, takes a plunge, so does the US real GDP growth. And we'll be talking about the US more. As you can see, so there is this fall in the credit impulse, but there is also the recent SVB saga and the other banks, and how did they fell, how did they collapse, and now we have dramatic tightening in banking lending standards. You can see this here on the right hand side. You can see the graph going upwards. You know, if you talk about certain specific tightening measures, so tightening credit for large to middle-sized firms rose from minus 1.5 to 46%. For credit cards, from minus 10 to 31% almost. For auto loans, 6 to 28%. And for commercial real estate loans, from 7 to 74%, which is very important because given the size of the US construction and housing markets in the total GDP. So that only exacerbates the fall in credit impulse. And next slide. So this is the demand for loans as reported by the banks. You can see, according to recent Fed survey, the net percentage of banks reporting stronger demand was actually negative. Credit card loan and auto car loan was fared a little better, but it remained negative. And you can, both of these slides speak to the first slide, which talks about that how there has been a fall in credit, hence falling economic activity. This has been also corroborated by John Kemp. I've written about it in my weekly research. In the weekly research article for primaryvision.co. You can check them out. So industrial electricity demand, the ISM manufacturing index falling. There are lots of indicators that cement this fact. Next, you see that about 472 billions of deposits were lost by the US banks, as published by FDIC, Federal Deposit Insurance Corporation, recently. And this all happened because of the recent SVB saga once again, and the 250,000 limit of insurance. Talking about fall in credit impulse, we see that this is not only confined to to the US, but also is showing itself in the Eurozone. So Eurozone credit impulse plunged to negative 6% in the first quarter of 2023. And this, of course, indicates an anemic growth. No doubt that Germany is in a recession. And overall, they have been saved. European economies have been saved with the milder than usual winters. But we will see how it fares. Overall, the Eurozone whole, in terms of credit impulse, it grew only 0.1% quarter one and was flat in quarter four of 2022 last year, indicating, what does this indicate? Once again, the slow economic growth. And the theme overall, of course, is what's happening with the global economy, certainly. Finally, China, the second largest economy in the world. So credit impulse for China has also been falling. It's anemic. It has been showing itself in weaker manufacturing data, which is actually the next slide. So recently, Chinese economic data came out, and it sort of disappointed once again. The manufacturing and non-manufacturing PMI, the manufacturing PMI fell to about 48% from 49%, which is already down from 50%, indicating contraction in the global in terms of its domestic economy, sorry, and also the property investment fell. So these things aren't only showing up in industry or manufacturing, in other sectors as well. So property investment fell by 16% compared to year-on-year basis. This was the fastest decline since November 2022. Apart from that, there are other, I mean, oil imports were down. So we see that, industrial profits were down about 20% in the first 4 months of this year. That these figures are really, really important, and they really speak to the global weakening demand. And you can also tie this down to what's happening with the oil markets. And my point is that it isn't only speculation that is driving the oil prices. I have been talking about this. Mark has been talking about this in our articles, in our blogs, in our econ show, in the EIA show, that there are indicators out there that are showing that demand wouldn't be as strong as previously estimated. So these are just sort of cementing those facts. However, there's a glimmer of hope. So Asian crude oil imports are expected to recover a little bit. A total of 27.73 million barrels will be offloaded at ports in the top consuming region, but that's about 8.6% better, to be exact. However, there is still concerns that will this continue? So is this one-off thing, as China is trying to suck up all the Russian oil recently? They've been tapping into their inventories as well. So the point is, where are things headed? Is this just for once? Is this a glitch? That's the main question. And you see that this weakness, what I was talking about, or what I was referring to, the weakness also shows itself in the container rates overall. So as you can see on your screens, the long-term ocean freight rates collapsed by about 30% in a month. So that's really staggering, right? One of the sub-indexes, which is the US import sub-index, collapsed 41% almost on month-on-month basis. Apart from that, the exports to imports to Far East, another index, it collapsed about 58.5% compared to year-on-year basis. These are serious figures, and these all show a slowing economic activity in the world. I'm not talking about a recession, full-fledged recession, but these figures are quite serious. Also, this was we discussed this in the previous shows, where I mentioned that the global freight rates have collapsed, right? So that's another important factor that you can tie this down with, and it all makes sense then. Once again, just to highlight this, the US manufacturing data and freight activities have been on a downward trajectory as well from the past 6 or 7 months. You talk about, if you talk about the distillate fuel oil supplied to US customers, that has also fallen down. I have written about it once again in the article. Please go check it out. It's free for this week because there was a lot of interesting information. So I said, why not? Why not? Electricity sales to industrial consumers also show a decrease. And this is 7 out of 8 months. Other factors that I've talked about, like fall in distillate supplies, is also 7 out of 8 months. Industrial power sales were down as well to more than 2.4% between December 2022 and February 2023. This placing it somewhere in the percentile which can be overlapped with figures in the 1980s. So this also shows underlying weakness. Moving to the oil markets now. So now that we have established the state of the global economy, it serves as a context to the OPEC meeting of 4th of June and why the decision was reached, as we will discuss right now. But before that, see this very interesting graphic by S&P Global Platts, and it shows the impact of Ukrainian war and the ensuing sanctions and the changing oil flows. As we discussed, the oil map is being redrawn, especially in the Asian continent. And you see that there are different things happening for different countries. Interestingly, look at Russia. So their GDP forecast is positive, whereas that of the Saudi Arabia is negative. These two stories are really interesting because they speak to a wider trend or a wider thread, which you can see here in this slide. This was an article in the Market Insider magazine, the website, and it talks about how Saudi Arabia is getting annoyed by Russia, as it continues its strong oil imports, despite being pledging to about 500,000 barrels per day of production cuts. We discussed previously that the top three oil exporters have been slashing their exports, but once again, Saudi Arabia takes the lead in that by 800,000 barrels per day, whereas Russia is has curtailed its oil exports by 300 barrels per day, 300,000 barrels per day. Finally, the final place is that of the US. So you have the weakening global economy. You have somewhat a rift between Saudi Arabia and Russia, because both now harbor different ambitions as the direction or the direction of their economic policy or their aims, the foreign policy starts to diverge in the future. And now we have today that there would be additional 1 million barrel cut by Saudi Arabia, at least for a month. We will talk more about it certainly as we get more details, but there was a very interesting article which talked about the recent changes in Mohammed bin Salman's behavior as blocking the reporters, certain reporters or certain media outlets to attend the meeting. That was because he thinks that the sentiment, the speculation is sort of undermining OPEC's and Saudi Arabia's role in managing oil markets. However, I tend to differ a little bit because I do not see. So Saudi Arabia is concerned with falling oil prices. They need about $80 per barrel oil price to sort of fund their economic ambitions, certain giga or mega projects, as they say. However, I think that the fall in oil prices cannot be only termed as speculation. It builds upon the recent fall in economic activity, which, I mean, really, you can just continue talking about it, how the different indicators are showing slowing economic growth. We have been following China. So from the past 2 or 3 months, the data has been disappointing. We've been following the United States of America, the largest economy in the world. The economic indicators there are also falling. We know that there has been a mysteriously pleasant oil report, and I will cover it in the coming days, but we've just seen how ISM manufacturing data, their exports, the imports, all of these things indicate slowing economic growth. Countries like Pakistan or other countries, they are facing issues like debt burdens, and all of this then becomes, it starts to make sense, the falling oil prices. So we'll see what happens. I still believe that oil prices will continue to face downward pressures despite this production cut. And OPEC has been really wise in its policy, forward looking, because they saw that there would be a fall in oil demand. Hence they cut previously as well, and now yesterday. So that makes sense from a realist point of view. Finally, the market sentiment tracker is once again trying to show a lot of bearish news. Germany's in recession, of course. China's PMI fell again month-to-month basis. Global Economic Surprise Index still down. Credit impulses I've just talked about in China across major 3 economies are down. Container indexes are falling. El Nino, the issue of El Nino is still there. The industrial activity is down. US ports, the shipping containers is down, 10% down. Asia's oil imports have recovered. Job report was better than expected. Bullish contracts in oil markets have increased, but that is, I believe, just because of this recent development. And China has boosted its natural gas output. But let's see, I think the outlook for a global economy still remains bearish. And that's all from my side today. See you all next week, and do check out that article, our work on primaryregion.co. Thank you so much.